Good day, ladies and gentlemen, and I would appreciate it greatly if you could click on the notification button below as well as the subscribe button because it's important to help support my channel so I can keep turning out these videos, and I would appreciate it greatly. Today's class is on Relative Strength Index, or better known as RSI. It is one of the most popular indicators used in Forex and CFD trading. RSI will work in almost any market and in any time frame. The Relative Strength Index is a momentum indicator developed by technical analyst Welles Wilder and was published in his book, The New Concepts in Technical Trading Systems in 1978. That's a long time ago. Now, I started trading in 72. So, you know I'm very old. But we didn't have computers. There was some beginnings of computers. Those great big rooms full of stuff, and some programmer who would sit in there, and if you'd have a request, basically all it was a big data sorter. But there was no internet. There's no Windows. So it did very little for us as individual traders. But RSI was one of the most respected indicators because the markets moved slower. Where there was no such thing as online trading. There wasn't a Forex market. CFDs didn't exist. So I traded agriculturals. Now, the commodities market as well as the stock market was a much slower moving environment. But RSI worked wonderful for them. As these new markets developed and as trading became faster, trading started using 4 digits to the right called pips, and we started using advanced charts. We found that RSI was easily adaptable, and the formulas still work just fine for short-term trading and fast market trading. Now, RSI tends to predict whether the markets are overbought or oversold. It is placed on the bottom of your charts, and it falls into a group of indicators known as oscillators. Oscillators bounce between a set of numbers, and in fact, RSI is known as a bounded oscillator. Why? Because RSI I don't know why my screen keeps changing here. Okay. Because RSI, the calculation always will come out between 0 and 100. And so it's bounded between those two numbers. We also have our area in between, which we call no man's zone, which is the area between 70 and 30, which doesn't tell us much. When RSI goes over 70, it's telling us the markets are overbought. And when RSI falls below 30, it's telling us the markets are oversold. Now, that's the standard definition. I'm going to take you over to the chart and show it to you. Now, over time, markets have changed, and a lot of people use 75 and 25 or 80-20 for the boundaries. So let me pop up a chart and let me show you what we're talking about here. This is my Euro US dollar teaching chart. So down below here, we have RSI on our charts. We can see that here we have the boundary set at 70 and 30. This is the standard default. Okay. You also have the 0, the 100 line, and the 0 line. So in this area between here, RSI is considered overbought, and in this area down here, RSI is considered oversold. So here we would say the markets were overbought. We don't actually see it falling down into an oversold territory in this short-term trading. But this is where and how we would use RSI. Now, if we go to the settings button, we can easily change, and when RSI is calculated on a look-back period of 14 periods. So here we're looking at a Euro US dollar chart in a 30-minute time frame. So that means we're going back 14 candles, closes, or 14 30-minute periods. If you're using a one-day chart, it would be 14 1 days. Okay. The colors don't mean anything. I set the colors so they're easier for you to see. In fact, I'm going to make the upper band and the lower band a little bit more visible for you. So what we see is this dashed, let's change it from a dash to, let's make it a solid line. So these lines are set at the 30 and 70. They could easily be changed. And there's lots of people out there, like I said, who use $75 and $25. Now it doesn't change the calculation, so it doesn't do any mathematical changes to the calculation. All it does is move your boundaries. So if you wanted to say you want your oversold more specific, okay, you want the market to be farther than oversold, you make it 75. Okay, because above 75 you're then saying it's overbought, and below 30 you're saying it's oversold. Okay, the mathematical calculation of this line hasn't changed one drop. It's just the boundaries. It will always come out between 0 and 100. And your interpretation then is whether you're using a 75, an 80, or a 70 as the overbought zone. And put your fence or your barriers on there. That's it. Now let's go back to my PowerPoint and let's talk about where this RSI comes from. Now, the calculation for RSI is relatively simple. You know, there's lots of oscillators and indicators that have very, very involved calculations. RSI is pretty simple. RSI is equal to 100 minus 100 divided by 1 plus RS. Now, RS is a little bit difficult, not mathematical calculation, just to grasp. RS is the average of the number of days, in our case 14 days, when the instrument closed up and when the instrument closed down. Okay, so to simplify the calculation, RSI has been broken down in its components. RS, it's the average gain and the average loss. So the RSI calculation is based on 14 periods, which is the default suggested by Welder. Okay, so what we do is we take the very first calculation for an average gain and average loss, or a simple 14 period average. The first gain is equal to the sum of the gains over the 14 days divided by 14. So you go back, and if we're using 14 half-hour candles, we take each one of those candles that had a gain. So in other words, it closed up, or we would say green candles, and take the gain from each period, add it together, and divide it by 14. Then we take the periods that weren't added to that because they were losses, and add them together and divide by 14. And then we add them together. And then after we've got our first RS calculation for the next ones, all we're doing is adding the previous gain times 13 plus the current gain and divided by 14. We're just continually taking a more advanced moving average, dropping off the oldest, adding on the newest for that RS calculation. And the default look back period is for RSI is 14. But we can also lower or increase the sensitivity by changing it to a 10 period RSI or a 20 period RSI. But remember, once you start making these changes, you have to also change your interpretations or your use of the RSI. So RSI is considered overbought when above 70 and below, or oversold when below 30. Now, it doesn't mean you just jump in the market and buy or sell, because an overbought market can remain overbought for quite some time. Now, that's why sometimes people raise the number to 80 or reduce it to 20. Okay. Short-term traders sometimes even use a 2-period RSI to look for overbought and oversold readings above 80 and 20. Since RSI measures the relative strength of the underlying market, it's a technical tool that can be applied to nearly any market. However, it's commonly applied to more liquid and large markets, and that's what we all trade. Now, remember, in a downtrend, RSI can remain oversold. In an uptrend, it can remain overbought. Now, what we often neglect is looking at the center line. The center line will help you in seeing what could be happening. The center line is here at 50. Actually, let me do it this way. Draw a nice straight line. Okay, is here at 50. If we remember when that RSI will always be a product between 0 and 100. When RSI breaks the 50 line moving upward, it's telling us the market is moving in an uptrend and heading, okay, it should match. We should see when RSI moves above that 50 line, it helps us to find that the market is moving in an uptrend. And we should see that number increase as that trend continues on. Now, what we're looking for is RSI to continue above that 50, moving up, 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 and then break the 80, 75, or 25. And that tells the market's in overbought territory. But that means the market can stay in overbought for quite some time. We're actually looking for the market then to ease back down into that 70 or 30 line and then break back above it. Okay, so when we get the break back above it or the break back into it, that's telling us we have something happening in the markets. And today things are pretty easy because we can apply what's called an RSI strategy. So we don't have to even look for this stuff. We can just go here and put the RSI strategy on here. And you see here, let me get my, let's make this a, okay. See right there, it's dropped it on there. We have the RSI strategy and it is working below. All it's doing is taking the application of below, put it in the formula, and here it tells you you now have a market that has moved from overbought into a reversal. Okay. And what happened was, a few bars later, we see this uptrend tick out and we go into that very nice downtrend. So if you were in the market, this is the point you would have wanted to get out. Even though you had this very long candle, you would have wanted to exit the market here because RSI has now moved above and overbought and then fallen back down to that 75 line. So there's lots of ways that you might want to apply your RSI. Okay, but you have to develop your own interpretation and your own strategy for this. But what I'm saying is now we have indicators that you don't have to spend all day trying to interpret this. So here below, we had a push and overbought. It fell back into our 70 range and bounced back. We got our indicator right here, and it was giving us a buy scenario. And we could have just used that strategy moving along. But we want to always track the 70 and the 30, or the 80 and 20, and the center line. So when these trend reversals happen, we want to get into the market and ride the trend as long as possible, and preferably until the next trend reversal happens. So how would you trade with RSI? So RSI is used in a number of ways. Three popular functions are overbought and oversold levels, RSI ranges, and divergence. Okay. So there's many ways in which we can apply RSI to our daily trading. But the only way you're going to master this is to make it into your own. Watch your charts and become completely familiar with the RSI so that you don't want to use the rules. You don't want to use 70-30 and become mechanical. You don't want to use break above 50 and become mechanical, because every market is different. Every asset is different. And you need to understand what works best for the asset you're looking at. And you need to be able to finally interpret what RSI is telling you and understand. But RSI is a very reliable indicator, but you can't blindly follow it. And the other thing is, remember, RSI does not tell you how far an asset should move. So it might give you an indication for a buy or a sell opportunity, but that opportunity may not be big enough for you to take advantage of, or it could be a very large opportunity. When it tells you to get out of the market, it has nothing to do with where you set your stop losses. RSI has several limitations, as all indicators do. Since the indicator is showing momentum, as long as momentum remains strong, the indicator can stay in overbought or oversold territory for a long time. Therefore, price analysis and some other confirmation is still needed for reversals. The same is true when using divergence with RSI. RSI ranges can help confirm trends, but each stock or market will have slightly different levels. So remember, the most basic RSI application is to use it to identify areas that are potentially overbought and oversold. Movements above 70 are interpreted as indicating overbought conditions, while conversely below 30. And then the level of 50 represents neutral market momentum and corresponds with the center line, as all oscillators do, like a MACD. So we also get a lot of failure swings. So customizing RSI to fit your type of trade and understanding it is crucial. But once you've figured it out, once you've made it your own, you'll find that it works extremely well in helping you foretell and interpret what the markets are telling you. Remember, keep an eye on the center line, keep an eye on the overbought and oversold, and remember, overbought markets can remain overbought for a long time, undersold markets can stay undersold. But the bottom line is RSI is popular because it has multiple uses. It is used to find entry and exit signals based on overbought and oversold readings and trending ranges, and can help spot or confirm reversals via divergence. Like any technical analysis tool, though, RSI is prone to give false signals. Price analysis is still needed to determine if a trend is present, and then the important RSI levels identified for that particular security. So thank you very much for joining us today. Please subscribe and please enjoy our YouTube channel. Thank you very much and have a great day.